For years, gold has signaled the world's deeper anxieties, quietly rising whenever nations lose faith in currencies, supply chains fracture, or markets confront realities they aren't ready to admit. In 2025, that signal became impossible to ignore. Gold prices pushed into record territory, central banks raced to accumulate reserves, and commodity markets entered one of the most turbulent periods of the decade. Yet while the headlines focused on the usual giants, China, the United States, and the Middle East, two countries moved beneath the surface in a way almost nobody noticed. Australia, one of the world's gold superpowers, began restructuring parts of its gold ecosystem. And Canada, traditionally seen as an energy and critical minerals player rather than a gold heavyweight, quietly positioned itself inside this shift. Not as a buyer, not as a speculator, but as a structural partner in a resource system now worth over $60 billion. Today, we're uncovering how Canada entered Australia's $60 billion gold play without a single major headline, how this move may change Western resource strategy, and why it could become one of the defining economic turning points of 2025 and 2026. And no one noticed. Before we begin, if you appreciate deep geopolitical breakdowns told through a Canadian lens, consider subscribing. It helps the channel reach more people who want fact-driven cinematic analysis just like this. Gold's 2025 surge didn't come out of nowhere. It was the outcome of years of financial instability. Central banks across Asia and parts of the Middle East sharply increased their gold purchases as a hedge against geopolitical fragmentation and currency volatility. Concerns over inflation dragged into a third consecutive year. Supply chains, especially those tied to minerals, faced continuing disruptions stemming from the post-2020 realignment of global manufacturing. These pressures forced investors and governments into the same historic safe haven they've relied on for centuries. That rush pushed gold demand into near-record territory, and with it, countries that dominate gold production suddenly found themselves at the center of a global strategy they didn't entirely choose. Australia, already one of the world's top two gold producers, felt this surge acutely. Its mines churned out tens of billions of dollars in bullion annually, and its gold export ecosystem became more vital than ever to both regional partners and global markets. Yet the 2025 environment wasn't merely defined by rising prices. For Australia, it became defined by restructuring, consolidation, and decisions that would quietly open a corridor Canada could step into. Gold, once just another commodity, had become a geopolitical asset again. And in this turbulence, a door opened. Australia's gold industry in 2025 was not the stable, linear success story people assume. Operational costs rose sharply across several mining regions, from Western Australia to Queensland. Skilled labor shortages, global inflation in equipment and energy prices, and increased environmental compliance requirements reshaped the economics of extraction. At the same time, Australian mining companies began reorganizing their portfolios in response to pressure from shareholders and international partners. Some refocused capital toward domestic projects with stronger long-term prospects. Others divested foreign assets to streamline operations. A perfect example of this shift came early in 2025, when St. Barbara Limited, one of Australia's notable gold producers, announced plans to separate or sell its Atlantic gold operations in Nova Scotia, Canada. Years earlier, this Canadian asset was meant to be a long-term strategic foothold for St. Barbara in North America. But by 2025, the company's priorities had changed. Management signaled its intention to either divest or spin off the Canadian operation into a separate entity listing on a Canadian exchange. This wasn't just a business decision, it was a structural withdrawal from a portion of the North American gold ecosystem. Moves like this matter. They change who sits inside the flow of gold financing, exploration, labor, ownership, and offtake agreements. When Australian capital reorganizes, someone fills the vacuum. And that someone, in this case, was Canada, but not through outright acquisition or central bank buying. Instead, Canada aligned itself through strategy, through alliances, and through a minerals architecture that touched gold without explicitly naming it. The quiet turning point came in Toronto in late 2025. During a G7 gathering of energy and environment ministers, Canada and Australia signed a joint declaration of intent on critical minerals collaboration. Though framed publicly around minerals like graphite, rare earth elements, and scandium, the minerals essential to batteries, magnets, aerospace, and defense, the implications reached further. The declaration committed both countries to deepen cooperation across the entire minerals value chain: exploration, production, processing, recycling, and investment coordination. For those watching gold, this was an unmistakable signal. Gold isn't classified as a critical mineral, but it moves inside the same financial and supply chain networks. The same companies, the same investors, the same trading houses, and in many cases, the same regions produce both. When two resource superpowers create a formal structure to link their minerals ecosystems, the impact spills into gold by default. Australia brings massive gold output, decades of mining expertise, and enormous exploration infrastructure. Canada brings financial engineering, regulatory predictability, and a growing leadership role inside the G7. Together, they created a corridor, not marketed as gold, but undeniably affecting gold. This was Canada's entry point, a move positioned inside a minerals pact, but connected to a gold market worth more than $60 billion domestically and internationally. Yet it drew almost no media attention. And that was the point. To understand the true magnitude of Canada's move, we need to look at another major development from that same G7 week. Ottawa's announcement that it would accelerate $6.4 Canadian billion worth of critical mineral projects and investments. This wasn't a small subsidy or a limited infrastructure upgrade. It was a coordinated multi-country mineral strategy that pulled 9 allied countries, including Australia, into a framework Ottawa called the Critical Minerals Production Alliance. The strategy included 26 new investments and partnerships aimed at strengthening supply chains, increasing strategic reserves, building refining capacity, and securing long-term offtake agreements with industry partners. The media focused mainly on environmental goals or its implications for electric vehicle manufacturing. But this framework did something more important. It positioned Canada as a central organizer of Western mineral flows. The architecture Canada built for battery minerals inevitably shapes how gold flows, or how gold becomes a part of Western strategy in times of financial volatility. By linking itself financially and structurally to Australia's resource sector, Canada pulled itself into Australia's gold ecosystem without needing to buy a single ounce. This is how structural influence works. It isn't loud, and it doesn't leave fingerprints. Corporate decisions often reveal geopolitical strategy earlier than governments do, and 2025 was no exception. When an Australian miner prepares to offload a Canadian gold asset, it means that capital is shifting. When a Canadian financing ecosystem quietly absorbs or reorganizes those assets, it means that Canada is increasing its upstream and midstream influence in gold, sometimes without even needing official government intervention. In parallel, Anglo-Australian giant Rio Tinto deepened its presence inside Canada's critical minerals expansion, particularly through scandium production in Quebec. Though scandium is not gold, the partnership formed through long-term offtake agreements created a deeper corporate and logistical link between Australia's mining ecosystem and Canada's mineral strategy. These companies don't operate in isolated silos. Their financing, exploration partnerships, and logistical pathways overlap across metals. A tighter Canada-Australia corporate mineral bond strengthens Canada's ability to influence gold markets indirectly through the broader mineral ecosystem that gold is embedded within. It's here that the symbolic presence of figures like Mark Carney becomes relevant. As former governor of both the Bank of Canada and the Bank of England, Carney has long advocated for structuring economies around financial resilience and resource security. His public stance that stable mineral supply chains underpin national economic power mirrors exactly what Canada and Australia created in 2025. His perspective is the intellectual backdrop of a strategy unfolding in real time. So why did almost no one realize that Canada entered Australia's gold orbit? Simple. The move was hidden inside agreements that never used the word gold. When governments talk about critical minerals, audiences hear batteries, electric vehicles, and climate commitments. When mining companies restructure foreign assets, analysts treat it as portfolio management. And when Canada announces a multi-billion-dollar supply chain initiative, the headlines focus on the G7, not on gold markets. But for those who understand how extractive industries interlock, how geology, finance, diplomacy, and supply chains converge, the signals were unmistakable. Canada didn't need to declare a gold strategy. It built one by entering the infrastructure around gold. The companies, the mineral partnerships, the regulatory alignment, the financial pipelines, and the diplomatic frameworks that shape how Western nations move resources. This is structural influence, not tactical influence. It's quiet by design. The deeper consequence is that Canada now sits inside one of the world's most profitable and geopolitically significant resource ecosystems without being a traditional gold superpower. By aligning with Australia, Canada gains insights, access, and strategic footholds inside a market that helps define global investor confidence. This matters because gold is not just a metal, it is a barometer of financial trust. When a nation influences even part of the system around gold, from corporate investment flows to mineral processing partnerships, it quietly strengthens its global economic voice. Canada also strengthens its role in a G7-led mineral security architecture aimed at reducing dependence on China. As the G7 works to build alternative supply chains for critical minerals and strategic resources, Canada increasingly becomes the diplomatic and logistical hub connecting multiple partners. It deepens corporate and financial ties with one of the world's dominant mining nations at a moment when resource power shapes geopolitical influence far more than headlines suggest. It reinforces its reputation as one of the most stable jurisdictions for resource investment, and investors, from mining companies to sovereign wealth funds, take notice of that stability. And by expanding this partnership with Australia, Canada positions itself as a minerals coordinator among Western allies, an increasingly important role as the world shifts away from vulnerable trade routes, unpredictable suppliers, and politically sensitive choke points. For Australia, the benefits are equally strong. Canada's regulatory stability, deep financial markets, and consistent policy environment make it an ideal partner in moments of global uncertainty. While Australia brings geological muscle and extraction expertise, Canada contributes frameworks that reduce risk for investors and governments alike. Canada's political neutrality within certain conflicts gives it diplomatic flexibility Australia can leverage, especially in regions where Canberra faces pressure due to its alliances. Together they form a resource axis that complements the existing Canada-Scandinavia and Canada-Japan alignments emerging within the G7, a web of strategic partnerships that quietly shift power away from authoritarian-controlled supply chains and toward a trusted network of democracies. This is the type of slow, structural power building that rarely makes headlines but reshapes how the world sources the materials that drive modern economies. Where does this go next? The long-term picture is clear. Canada will continue expanding its role in Western mineral governance as the world recognizes that energy security, technological development, and financial resilience all depend on secure access to strategic materials. Australia will maintain and modernize its mining dominance, particularly in gold and lithium, as demand for these resources grows across clean energy, defense technologies, and global investment markets. More corporate deals are likely, including shared financing vehicles, shared processing technologies, and potentially even joint development of mines managed through Canadian capital but operated under Australian expertise. As gold remains a global hedge against uncertainty, Canada's new position inside the architecture around gold, not merely inside the commodity itself, becomes a strategic advantage for its economy, its financial system, and its geopolitical posture. This partnership also positions both countries to influence how Western democracies structure their long-term mineral policies. As countries seek alternatives to China's processing dominance, the Canada-Australia corridor becomes a template. Two politically aligned, resource-rich nations coordinating investments, standards, and supply chain routes across half the globe. In time, this axis may expand into shared refining hubs, cross-listed resource companies, and coordinated export strategies toward Europe, Japan, and South Korea. As global volatility persists and markets look for stability, Canada's involvement in Australia's gold and minerals landscape indirectly gives it leverage that extends far beyond mining. It gives Canada a stronger voice in global economic stability and security discussions, because influence in minerals translates to influence in finance, manufacturing, and diplomacy. In a world where supply chains are vulnerable, currencies fluctuate, and metals underpin both economic stability and military capability, alliances like the Canada-Australia Resource Link are far more influential than most people realize. Canada didn't enter Australia's gold play from the front door. It entered through the architecture behind it, through the frameworks, partnerships, and corporate links that shape how gold moves long before it ever reaches a trading desk. And that is often where real power is found, not in the headlines, but in the foundations beneath them. And this is how Canada just entered Australia's $60 billion gold play, and no one noticed. If you found this analysis valuable, I recommend watching the next video in this series. Don't forget to like, share, and subscribe, and leave a comment if this changed the way you see global resource politics. Thank you for watching Geocapitalist, and until next time, stay informed, stay curious, and stay ahead. See you in the next video.